Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Among the major asset classes, no market has experienced the sea change in volatility levels more so than the U.S. government bond market over the last few years. Consider that the MOVE index reached the low 40s in 2019, spiked to 160 during the March 2020 COVID crisis, descended below 40 in late 2020, and then surged in 2022, again reaching 160. It is against this fast-changing risk backdrop and exceptionally high vol that I had the pleasure of welcoming Deep Kumar to the Alpha Exchange. The Co-CIO of III Capital Management, Deep is engaged in finding value in global government bond markets, deploying relative value strategies across the curve, and utilizing derivatives to seek out asymmetric return opportunities. Armed with a PhD in hypersonics, Deep hit Wall Street in the mid-1990s, building risk and pricing models that leveraged his understanding of the math that underpins derivative pricing. Our discussion looks back on some of the formative events that Deep has encountered and how those have cemented the idea that volatility itself is volatile, a notion that matters in option pricing, especially when risk managing exposure to deep out-of-the-money strikes. The back half of our discussion considers the here and now and what Deep sees in the prices on hand. In Japan, we discuss the JGB yield curve Kuroda kink and relate the importance of positioning, in this case by the price-insensitive BOJ, in impacting market clearing prices. On the U.S. front, he sees excess optimism reflected in the belly of the yield curve, where the meaningful inversion between 3-month bills and 2-year notes suggests an ongoing trend in disinflation that will enable the Fed to begin easing in 2023. Skeptical that this can occur perfectly according to plan, Deep is using OTC derivative trade structures that capitalize on a reversal of the negative term premium currently priced in the curve. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Deep Kumar. My guest today on the Alpha Exchange is Deep Kumar. He's the Co-CIO of III Capital Management, a firm delivering risk management solutions and looking for uncorrelated alpha, oftentimes through derivatives. Deep, it's great to have you on the podcast today.
Thank you very much, Dean. Looking forward to this podcast for weeks now.
Absolutely. Me too. You've got this deep background specifically in interest rate derivatives among your areas of expertise. And boy, no market had a sea change in terms of its risk paradigm more so than the U.S. risk-free market. It was hardly risk-free last year. We'll get into that and more in our conversation. As we get going, let's just learn a little bit more about your background, how you wound up in markets. You've got a PhD in hypersonics. Tell us a little bit about your academic studies and maybe how those led to this career in the quantitative side of markets.
I go back to 1994. I started in the markets in September 94. From 1990 to 94 is when I joined what was Cranfield University back then. And I did a PhD in hypersonic aerodynamics under a professor named Professor John Stollery. And the thesis was on the controlled effectiveness of vehicles traveling at Mach 8 to Mach 12. The technology was in its early days back then, but it's very relevant for controlling missiles that are designed to intercept other missiles, like the Patriot system that was being used in Iraq at the time. This finished in 1994. The USSR had just broken up. What I'd say is peace broke out. It was swords for plowshares back then, and no one needed a high-speed missiles guy. But luckily, the derivative markets were taking off. So I went to the City of London and started as a quant analyst in the fixed income model validation team at what was Chase Manhattan, and now it's JP Morgan. Spent a year there, moved to Paribas. There, the focus was excellent for me. In the fixed income team, it was some of the best traders, risk managers, and quants, I think, in the world. And at that time, Frederick Jambon had just become the global head of trading. And I worked closely with Frederick and with other heads of trading, Guillaume Amblad, Christian Mendigo, in terms of developing the fixed income model, the risk management frameworks, the pricing frameworks to handle complex fixed income instruments. And amongst them, I found a home. It was very much using the math that I learned at university to apply that to markets. We did some fantastic work, like looking at things like risk-adjusted return on capital and the issue of incorporating fat tails into calculating risk capital correctly. After that, joined III Capital Management, what is now 20 years ago. It's actually 20 years in March. And here again, I got very lucky and got the opportunity to learn from the founding partners, Cliff Biner and Warren Mosler. It's been 20 years of learning since coming here. Throughout the time, it's really about using the math, using the quantitative frameworks and applying it into different industries, initially into the missile industry, and now here in terms of using it for markets and to look at different things in different markets.
Well, congrats on 2 decades. So that's a great anniversary. I tend to really enjoy looking back on events of consequence, especially insofar as risk is concerned. I think there's the most to be learned in markets from when times go spectacularly wrong. And so we're on the 25-year anniversary of the LTCM fiasco in 1998. And that's a period that was pretty formative for me. And I'm not even in the fixed income markets. I came at it from an equity derivative lens. And turns out that that was a large portion of their losses was just being short long dated Vega at very much the wrong price and getting marked out of it. The biggest exposures really were through swaps and various risk premium generating activities in the fixed income markets. What was that period like for you sitting in a seat modeling interest rate and interest rate derivative exposures?
I'll take you back a little bit. And this actually goes back to my professor's days. The professor had written on the wall, this was in the university in his office, was actually a little placard. And he said, to make it fly is everything. And it's very similar process here to what Professor Stollery had, which is to generate positive risk-adjusted returns is everything. You go back to the time of LTCM, you look at what happened with LTCM. It was leverage. They were over-leveraged. They had 100 times balance sheet on securities leverage. Now, prior to LTCM, it didn't matter. Nobody questioned it. But when the problems of the Asia bust coming through into the US, then leverage all of a sudden became an important piece of markets. In all of the risky times, these risk episodes, LTCM actually is the first real risk episode that I experienced. After that, there's things like the 2002 internet equity blow-up that we had, the ultimate leveraging of credit through banks in '08, and in 2020, again, the leveraging of markets through shadow banks. And in all cases, it comes back to trying to model the leverage piece of it. And the consistent period is not the risk blow-up event, but the low volatility period that precedes a risk blow-up event. And if you look at LTCM and you look at volatility in interest rate markets in early 98 to mid 98, those were some of the lowest vols that you had. To generate returns, you had to leverage up. And that's what people were doing. You look at '02, similar. You look at '08, there was '06, '07, or '05, '06, similar. You look at 2020 and 19, 18, 17, similar. And so it is about the creation of leverage, the need for investors to use leverage to generate returns, which ultimately leads to the blow-up environment being created. And then a spark sets the blow-up off.
There's some version of Minsky in there that you're describing, which is this financial instability hypothesis. And it, I think, does a great job of separating the physical sciences that you're an expert in from the quasi-physical modeling capabilities that come in markets. Minsky's got a great quote. He says, "Success breeds the feeling of the impossibility of failure." And I'd love for you to just reflect on that, maybe just with respect to the notion of successful trades and how they get larger over time. And maybe as they get larger, perhaps they're underwritten at riskier prices with thinner margins of error. Walk us through that, what you've seen just over the course of time, maybe specifically in fixed income markets with regard to some of these risk events.
If you look at even risk-free trades, in things like asset swaps. And one goes back to 2000 or 1998 in the LTCM time. There, it was very similar, very low volatility in the summer of 98, progressively bigger leverage being taken on spread products. And activities such as asset swapping was really not really functioning in the classic sense where a lot of people work with models like VAR. And so as volatility goes down in markets, your leverage naturally increases into a lower VAR framework. And so then ultimately, if there isn't a check on how much you can leverage it, then you just progressively increase your leverage and it gets to a point where it is excessive for markets. And then if there's some kind of a rapid need to get out, then you have problems. You saw this in 98. You saw this in 02 in some of the fixed income credit markets after the internet boom. You saw this, of course, in 08. And then you see this in 2020 with basis swap trading around the time of COVID as well. And then more recently, we've had the experience last September, October, even of pension funds and gilts and the leveraging of gilts that pension funds were doing. And as they needed to exit markets, the liquidity just wasn't there. So it's a combination generally of high levels of leverage, limited balance sheets on the exit, and the balance sheet on the exit getting withdrawn very rapidly on that. And that combination is what I think is leading to these times where you see risk and volatility in risk assets really increase rapidly.
Well, between 02, 08, 2020, that just gigantic basis differential between on-the-run government bonds and maybe futures, things that are entirely related except for pure liquidation periods. And then, as you mentioned, the gilt crisis. So you've given us a lot to dive into. I was looking at your bio. One of the pieces that you published was on this notion called the smile, this sort of observation that we see in markets that the pricing of options across different strikes is just not really consistent with what Black-Scholes would suggest, which would be no smile, no skew. I'd love for you to just talk about that in terms of what you wrote about there, and then maybe broaden it out to maybe some of your observations, experiences with regard to how markets behave and then how the market effectively makes adjustments to the pricing of derivatives.
So the work that we did on volatility span, the lead author on the paper was Patrick Hagan, who was a wonderful quant that I worked with at Paribas. What we were doing was to get a fair value for the out of the money. The approach that we took was that if you look at out of the money options, they have a convexity with respect to vol, and they are positively convex with respect to vol. And so what we said was that one of the assumptions in Black-Scholes is that vol doesn't move, that vol remains constant. It's the underlying that moves in Black-Scholes, but the vol didn't. That was an approximation they made. And so when we said, look, the market's underpricing the convexity because the market's assuming volatility doesn't move, and reality is volatility does move. And so if you factor that in, then the pricing of the out of the money options needs to be richer than what Black-Scholes implies. And so there is a natural value to it, which is what the realized volatility is. And so we brought that into the framework, and then that pushed the prices of the out of the money options to a fairer level by creating smile, by richening the volatility of the out of the monies. And that's what you see as the volatility smile. Embedded in there, and you take that and you look at what that implies as a distribution, and it implies a fatter tail to the distribution than what a Gaussian or a normal framework would imply. And so it is the stochasticness of vol, the ability for vol to move, implicitly results in richer or fatter tail outcomes than otherwise. And that's what the Sabre model pushed the boundaries of option pricing to bring that into the option pricing world. We've taken that from there, and especially here at III, some of our risk capital frameworks actually incorporate fatter tails into that risk capital. And what that does is it limits the ability of a portfolio manager or a position. What it limits is that even though you may be in a low volatility world today, volatility may jump, that it's not constant, it may jump. And if it jumps, then you need a fatter tail to handle that additional volatility. That ability, that's what we've managed to factor in to our risk capital assumptions. And it sort of extends that work of Sabre and what we did in terms of pricing of options to the risk capital formulation framework as well.
If we look at the equity derivatives market, we'll just stay with the S&P 500 and characterize that as a option vol surface that's typically got skew. It might have a tiny bit of smile, but by and large, the risk premium across the vol surface really starts to get heavy when you consider downside puts. You can attribute that perhaps to 1987, the idea that markets crash down, not up most typically, that people are long stocks, so they need insurance. On the rate side, and this is what I was just hoping you could give us a little tutorial on, it's kind of unclear at least in a developed market like the US, a deep government bond market, where the smile ought to be. Is it to the higher rate side? That could be an inflation shock that could be risky for the economy. The lower rate side can be risky as well. Markets can get pretty volatile as rates fall, but then you also have this, at least we thought was a boundary around zero. Give us just a brief tutorial on how experts like you think about the surface in terms of interest rate volatility to the higher side and the lower side.
Rate markets differ from equity markets in that there is a floor to the rate. Used to be zero, that nobody's ever going to take the rates below zero until the central banks did. And once they took it through zero, it became clear that zero is not a boundary. But there is a boundary. You saw the ECB floor out at about 0.75%. They were not willing to take it any lower. And so there is a concept of a reversal rate, a rate at which below it makes more sense to take your money and put it in the mattress rather than stick it in a bank. Some concept of that. And so with that reversal rate framework, there is an underlying boundary. And what that says is that ultimately, if your rate is going to approach that boundary, then volatility-wise, you're going to squeeze the volatility lower because your distribution to the downside on the rate is being contained or curtailed. It matters about what is the distribution on the upside. So effectively, half your distribution is truncated. And if you truncate the distribution, then two things happen. One is that you're going to drop the volatility because now you're saying I'm only going to move half of what I'm normally going to move. And then the other is the skewness in that distribution. And the ultimate expression of this was yield curve control in Japan, where they floored and they said, okay, we're going to have the 10-year JGB at zero. And in the initial setup was plus or minus 10 basis points. And so what you saw was the 10-year JGB, the markets did the work for the BOJ of bringing the JGB rate to zero and keeping it within a plus or minus 10 basis point band. It is very clear that once you do that, once you restrict the boundaries of rates, that the volatility has to respond. That's at low rates. If once you get the rates becoming freer, for example, 5% well away from the boundary, then they tend to have a distribution which is much more akin to normal. If expectations are normal, then it starts to reflect normal plus the volatility of the volatility itself. So the skews will symmetrically richen. And then you end up with situations where there's biases to higher rates like we had last year. And so the higher rate skew, what we call the payer skew, will richen relative to the lower rate skew, the receiver skew. And so that asymmetry starts to build in. When we were designing the model, the stochastic volatility frameworks have been out there for a long time. When we're designing the model, there's actually a term in the math that we brought in to take the ability to adjust the volatility of volatility for the skewness. That feature of the model actually allowed us to much better fit the framework. And that was a feature that came into markets. I first saw it in 1999 when we had the inflation sell-off in longer dated rates in late 99. Sabre was fitting into that. But what it says is that in rate markets, if you're close to the boundary, then you're sort of one-sided in your skew because, you just can't go through the boundary. If you're well away from the boundary and well away from the reversal rate, then you can be much richer in both skews. And then it depends on biases in terms of inflation and things of that type as to whether one side of the skew is richer relative to the other.
You referenced this boundary that we thought was zero, but it wasn't, specifically the ECB taking its deposit rate reasonably into negative territory, and Japan did the same. So I want to circle back to yield curve control in a bit. But what I would love to do first is just to get some of your perspective, because as you talked about the ECB going reasonably negative, this was a period where the Fed was not negative, but close to zero. And you had interest rate volatility at extremely depressed levels in 2016, 2017. Things started to perk up as Trump started to utilize the trade war, and Powell tightened a little bit in 2018. And then, of course, we had this just gigantic surge of vol through the COVID crisis for the market in March. And then just as soon after that, some of the most depressed interest rate vol levels, as Powell was promising that rates would stay at zero for such an extended period of time. So from incredibly low to incredibly high, back to incredibly low, and then back to very high in 2022. So you've seen a lot. Just give us some reflection on those 5 years from 2017 to 2022 and the types of strategies that III would be deploying or employing, and the kind of thinking that you'd have from a risk management standpoint during these big transitions from low to high and back.
There is the 2017 to 2019 period. We'll go back a little bit, 2016 to 2019. Ultimately, what we were seeing was the low vol period is for interest rates. It's about two things. It's about what the central banks are doing at the short end and how active is policy at the short end. And then how active is now things like quantitative easing, and that impacts the long end interest rates. They're typically buying duration. They're buying through the asset purchases. They're positioning into long-dated duration. And then thirdly, the other thing that is a big factor for rates is the outlook for inflation and the outlook for the economy. And implicitly, they're connected. And so you think about inflation and the economic outlook, pretty benign inflation throughout the period from 2014 onwards into 17, 18. There really wasn't any inflation. I think it surprised. I speak to a number of very prominent economists, and I think some of them felt it was possibly a policy error, that the Fed actually went and tightened in 2017 with inflation at 1.3%. There wasn't any inflation pressure, and what are you doing tightening so far below your inflation target? The other side of that is the quantitative easing, and you saw in 18 and in early 19, the ECB actually came out and re-engaged in QE and really pulled long rates down substantially in Europe. And this was all going on while the Japanese are doing asset purchases as well and controlling rates through yield curve control. All of that combined to generate a very low volatility, risk-free rate framework. Of course, you had the COVID situation then explode. Global growth came into question for a long period of time. Markets, if you go back to early 2020 or just after COVID, we were pricing for the Fed to be on hold for 5 years, pricing for central banks to be on hold well into 24, 25. And so you saw the entire rate structure in the US get very depressed. 2-year rates were flat to the front 2-year rate, which is no term structure at all in the curves, and everything against the boundary of zero rates. Because of some of the money market frameworks that we have in the US, you couldn't take rates negative, but you were against the boundary at zero, and we stayed at zero. But we termed out the term structure for a long period of time at zero. That squeezed out volatility, and so implicitly, by that squeezing out against the boundary, you saw rate volatility compress down to very low levels throughout 2020. Similar in Europe, ECB rates were negative, but again, you pressed the term structure and squeezed out the term premium down to nothing. And so European rates were very low, Japanese rates were very low. And so as a result of that, you saw global volatility levels get very low. Now, everybody has a need for yield. And so how do you generate yield in a low yielding framework where there is very little term premium in the curve? you start selling volatility against it. And that sale of volatility is what you saw result in volatility itself cheapening in rate markets. Then along comes the vaccine in late 2020, the Pfizer vaccine. With that comes the reflation premium. And behind that is also, which is, I think for us, it was very key to what happened, was the fiscal easing that governments did in 2021 after the Biden election. And what you saw there is enormous levels of fiscal deficits being run across jurisdictions, whether it was US, Europe, Japan did price controls, implicitly subsidizing their consumers. And so the result of all of that was that inflation came into the system. US, I remember a comment that we're effectively at war against COVID. And if you look at US deficits that we were running, we're very similar to the deficits running in wartime. And so that injected a lot of earnings into the consumer, which ultimately fed through into inflation and the pickup in inflation. And now the inflation premium had to be priced back in. And with that inflation premium being priced back in, we saw the term premium restore itself across yield curves. And with that restoring of term premium came the volatility that we saw in 21 and 22 in rate markets.
So much of what you are tasked with doing is about evaluating uncertainty. You're looking at option prices, and those are expressions of the degree of uncertainty that's baked into prices. And then you're trying to evaluate things on a forward-looking basis. And something you said there, I'd love to talk a little bit further about, which is just this notion of we had a lot of monetary stimulus. We had the post-emergency QE in 2013, 14, 15. We couldn't seem to get off of it. Inflation didn't really move up very much, but post that Pfizer vaccine and then that onslaught of fiscal stimulus, it did seem like something was different, but it was hard for us to know exactly if that was the case. What was on your mind at that point, just in terms of saying, hey, there could be something here, but boy, we haven't seen inflation in 40 odd years. It's difficult to really position for. What's the balance of action versus inaction in that circumstance?
I'm actually on record on this, Dean. We go back to July of 2020. We actually talk, and we do a webinar here at III. I do a webinar every quarter. And the July webinar was titled, Bonds Just Don't Do It Anymore. And that was the 30-year bond yield got down, I think in the range of, I know the 30-year swap yield got down into sort of the 80 basis point level. And we were questioning, where's the hedge? Where is the 60-40 hedge at this point? So from there, as that came on the table, then for us, it became, well, there's all this reopening. We were looking at the reopening. We were seeing signs that, yes, if you open the doors and start having consumption pick back up, that there's going to be a pulse where you can't lock up people year after year and say everything is going to be okay. People will want to spend. People want to party. We're in Florida here. Our offices are in Boca Raton. People wanted to get out. People want to enjoy the world. And so with that, consumption we thought would come back. And when it came back, that 85 basis points on a 30-year rate didn't seem like the right level. And so that was the uncertainty that we were seeing. Markets were not seeing that uncertainty at that time. We actually positioned our portfolios into the rate vol environment. Rate vol was relatively cheap, and markets were skewed very much into the view that this environment was going to sustain for 4 or 5 years, which we didn't see happening at that time.
Yeah, it's easy as an outsider to look at prices without having to own the mark-to-market risk. But boy, there was that coincidence of incredibly low rates. I remember the 5-year was 26 basis points. And of course, vol on that 5-year note was also at an all-time low at the same time. So there just seemed like a pretty interesting loaded spring. Even if it didn't pay off, it seemed like a good what if to have on the sheets. I'd love to talk a little bit more about 2022, just in terms of the experience of managing a vol book. One of the things that was a conversation amongst people in markets, and probably continues to be, is just the durability from a liquidity standpoint, even of U.S. government bond markets. We watched the gilt market completely implode. There just was a complete breakdown of the ability to absorb the selling pressure, just given, as you said, the leverage And there's been periods of time, from what I understand, in US government bond markets where liquidity has just not been what you'd want it to be. Liquidity and volatility are similar. Walk us through the experience of trading through 2022, specifically from managing a derivatives portfolio in US fixed income.
If you look at 22 really starts in 21, and it was a flow through of Q4 of 21. And if you look at Q4 21, here we were talking transitory by the Fed. And Q4 21 is the realization that it's not transitory, that we are going to have to start to tighten rates. We are going to have to pull back on the levers of QE. And so the repricing that generated, what does QE engender? QE is the central bank buying treasuries, giving you dollars, and then you're doing something with those dollars. Typically, you're going out and getting additional yield on those dollars and reinvesting those dollars. And you saw this happen through 2020 and 21 with especially U.S. banks and leverage in U.S. banks as they were selling out their fixed income holdings. They were going and buying new issued treasuries and mortgages. And so that combination leads to a lot of leverage being created in banks. There wasn't much loan growth to offset the deposits at the banks that were coming into the banks. And so the banks were taking on duration securities as a result and putting that in their available for sale type accounts. What you saw as the Fed started to talk about taper is the banks start to step back from that. You saw banks take a lot of pain on the MBS holdings and the Treasury holdings in Q4 and Q1. Q4 of 21 and Q1 of 22. You saw mortgage securities, which have this embedded prepayment option. You saw mortgages extend into becoming higher duration. So not only are you losing on a mortgage because the rate's going up, but the duration of that mortgage is starting to increase and increase rapidly. And so the rate at which you're losing this, what we call negative gamma, that negative gamma feature of mortgages comes into play as well. And so all of these players are trying to get out of what is a very tight door. There is increasingly now the trading frameworks on fixed income. The bid-offer charge of trading on fixed income is actually a function of volatility itself. You can imagine you're trying to get out of the door. Everybody's trying to get out of the same door. The markets can only absorb so much going through that door. As a result, the bid offer now increases, and now you have to liquidate further into that. And this sort of negative looping, negative feedback compounds on itself, ultimately being reflected in the volatility markets as higher volatility on fixed income rates. That was the key that we were seeing. And so we saw that in 22, start in early 22, late 21 in the US, fed through into Europe as well. And you saw the bull shock and markets pull back there. The interesting thing is that the European mortgage market is actually surprisingly large. The fixed income, fixed rate mortgage market in Europe is surprisingly large, is of a similar size from what we understand to what's there in the market. The only difference between the US mortgage market and European is that in the US, mortgages are done as a securitized product, and ultimately Freddie and Fannie and the GSEs manage that risk. In Europe, the risk is being managed on banks' loan portfolio. So it's a mortgage loan and the loan portfolio. So individual banks across different countries were having to pay into the rate rise in Europe. And that sort of compounded the global push higher in interest rates. And then Japan is the next one. They haven't really gone, but long-dated Japan rates beyond the 10-year JGB, those started to reprice as well. That picture, I think, is yet to normalize in Japan. And I think that's more a 23.
You mentioned the Fed's being fixated on this notion that inflation was transitory. It turns out not to be correct. The inflation data materializes. The market doesn't like it. And you kind of see this buildup where metrics like the MOVE index are rising, stock bond correlation turns positive. But now that's months ago. And now we've got something that might be a little bit more benign for the Fed and for markets as well. Do you feel like we're reasonably along just in terms of the adjustment process? Outside of some unknown, have we seen the highs in interest rate volatility for this cycle? How do you see things materializing in 2023?
We're not zero anymore in interest rates, so that's a good thing. We priced higher. The interesting thing is if you look at the term structure of interest rates, we have this 5% being priced for the short rate. So policy is correctly priced at 5%, we think here. What's interesting is that the market then very quickly goes and reduces that down to 3.5 by the end of 24. And then it stays constant thereafter, or about 3.5 thereafter. And what it appears that the market's doing is making a statement that, yes, they're going to tighten to 5%. We're going to be at 5%, likely the summer of 23 is what the term structure is saying, but then turn and start to ease very rapidly and ease by 150 to 200 basis points over the subsequent 18 months. And so you get this L shape in the curve. And so I've been questioning the L. The L shape is pricing for the Fed to tighten to 5%, wonderful, and then thereafter ease very rapidly. And that just sounds like everything is perfect. We had a conference last week here at III. What I said at the conference was that in every fairy tale, everyone lives happily ever after. The L shape is priced for that fairy tale. It is a lot of information being priced to perfection in the curve. And what I'm concerned about now is, have we tightened enough? If we haven't tightened enough, then do we get the Fed turning around at some point and saying, yes, we got to tighten more and we got to take rates more restrictive? That's not being priced by the curve. And the other thing that's not being priced by the curve is that we could be higher for longer, which is what the Fed is telling the market, that the Fed is going to stay at these elevated levels until we see inflation return to target as such. And everybody's projection is that we're going to get sub 3% towards the end of this year. And then by the middle of next year, we'll be at target on inflation. And there, I think, is the risk for 23, is that the L shape is not realized, and then markets have to price out the L shape. That could be 100 to 150 basis point repricing in the term structure in the belly of the curve, what we call between the 2-year and the 10-year section of the curve is where we see the greatest amount of risk. And there we are positioning ourselves to be long volatility in that sector of the curve.
2s, 10s probably gets the most play just in terms of what's published and what practitioners look at. There's all other parts of the curve as well. And I think one of the ones you were kind of implicitly referencing earlier is something like 3-month, 2-year, where that's about as inverted as we've seen it anytime back since 1990. I think there are maybe 2 other instances. One is in 06, and it happened again in early 08. And I think another one is around the turn of this new century, around 2000. That one tended to be a pretty good forecasting vehicle for equity weakness coming. The second, it's hard to say. But when you look at the degree of inversion, let's say, between the 3-month bill rate and the 2-year note, what is it telling you about the market's expectations? And then in terms of trade design with regard to carry, how does someone like yourself position around that deep inversion?
That 3-month to 2-year, that inversion that we're seeing in the curve, very much is pricing for what I call the Cinderella outcome of, yes, inflation will fall, the Fed will respond by easing and ease rates such that growth is not impacted, and so on. It just seems too much information is sort of priced into the curve. That's the statement that the market's making here. And that's what I think in terms of you look at inflation projections are very much pointing to that steady drop into a 2%, 2.5% zone for the end of this year. If you look at those projections, those inflation projections that were there in 2022, in 21, in 20, it was similar. And it was, okay, we're going to go up, but we're going to drop back down. And in every instance that we saw of an inflation projection, we were seeing this sort of normalization. It's an acceptance of the Fed's credibility, that the Fed has a very credible stance on inflation. They have done amazingly well for 30, 40 years squeezing inflation out of the system. They understand how to squeeze inflation out of the system, and they will do that again here. That's what we think is priced by that 3-month to 2-year inversion. Think about if somebody's buying that 2-year or 5-year treasury here, you're going to be negative carry. And carry is an important part of buying treasuries. You're buying some element of term premium that your investment of time is returning some additional premium to that. And so that we think is where there's an element of mispricing, if you could call it that, in the curves right now, is that investors are not really being compensated for that terming out of the debt. And so that's what we think could get repriced, and those yields could be higher. Very hard to position into it. One of the things here at III that we do, and we do this very well, is actually the structuring of our trades so that we try and generate asymmetrical returns in our outcome. We'll invest $1 of risk capital with the goal of really returning more than $1 if our view works out. The way we do that is actually mainly through options and using option-based structures where you pay a premium and then the return on that premium is a convex return. The other side of the option equation is that what you're doing is by spending $1, you're defining your downside, that if your view is wrong, and by all means, we are not the most amazing macro guys in the world, we don't claim to be. And in that situation, if our view is wrong, we're going to lose the dollar. We're going to define our downside to $1. And so we look at this L-shaped curve, and what's clear to us right now is that the curve forward is too steep. The curve spot is flat. The curve forward is too steep, and that forward rates are too low. And so what we've done is combine these two pieces of information to say that what we want to do is on a forward basis, where the curves are steep, we want to buy a curve flattener, or what we call it in option terms, a curve floor, contingent on rates being higher. And that's an option structure which trades actively in the market. And we've been engaged in that structure to position forward curves to be flatter and for rates on a forward basis to be higher.
So tell us a little bit just more about that structure. It's certainly very interesting. Just in terms of the variables that go into pricing it, I assume that there's some correlation element that goes into it since you've got multiple legs there. Can you just talk a little bit more about the way in which that structure works?
What you do is, and this is something that is an OTC structure, so you'll be doing this with a dealer. Basically, what you're pricing for is that if you look at the spot curve in the US, and I'm going to talk swaps here, spot 230s swap curve is inverted 120 basis points. 2 years forward, the 230s swap curve is flat. So there's 120 basis points of steepness that markets are pricing in, that if we go from where we are right now to 2 years forward, that curve will be steeper by 120 basis points, i.e. the spot curve is 120, the forward is 0. So what we're doing is buying a floor, a flattener on the forward curve. And for that floor, you pay a premium and you'll pay X number of basis points for that floor. Then what we say is, look, in what circumstance is that floor going to perform? And in our view, the circumstance where it performs is not if the Fed is cutting rates, but if the Fed is holding rates or raising rates. So implicitly, there is a higher rate view that we're taking in there. And so what we do is say, okay, let's buy the curve floor, but make it contingent on rates being higher. That contingency reduces the outcomes where we're going to get paid because it's going to be only in higher rates. If rates are lower, we're going to lose our premium. And so by putting a contingency on there, we're basically saying, okay, instead of paying us both in higher and lower rate environments, just pay us in the higher rate environment. And that reduces the premium substantially on the option. The option markets price that through a correlation framework. That correlation framework is what we use. And those correlations have been at near zero in terms of what that pricing implies. And so that's what we use. And that's the structure that we use to position for this sort of an outcome.
It's really interesting. There's a number of other trades that are cross-asset. You and I have spoken about rate contingent puts, which was a big trade and very successful last year, where it's just a put on the S&P contingent on rates rising, which in the good old days of standard risk on, risk off really never happened. It was risk off and rates would typically fall. And so the pricing of that correlation was just very advantageous in providing you cheap equity protection. Let's circle back to JGBs because this is another area I know you're doing a lot of thinking on and got some trades that you guys have put in the books. This is a really interesting one. I'm just an outsider staring at this curve and you've got this kink. Some people call it the Kuroda kink between 9 and 10 and then 11. The 10 just stands out. So I'd love for you to just frame what the BOJ is up against. Are there risks that this thing just goes haywire, or is there more likely a happy ending where the market just loses its attention span again? Walk us through your thinking there.
You look at the 9, 10, 11 kink, and it's interesting that the yield on a 10-year is substantially lower than the 9-year and also substantially lower than the 11-year. And you think about arbitrage frameworks, and somebody somewhere is making a statement that, okay, if I have a 9-year JGB, the Japanese government bond, if I have a 9-year Japanese government bond, its yield is going to be very different, and it's going to be higher than that of a 10-year and that of an 11-year. Your 11-year Japanese government bond next year is actually going to become the 10-year, and then it's going to become the 9-year, and the 10-year is going to become the 9-year next year. This is this thing of time inconsistency in the curve that we're seeing, this sort of a V structure in the yield term structure. And what's going on is that the Bank of Japan has put together this framework, what they call a yield curve control framework, to limit how far the 10-year JGB yield is going to go. And you think about central banks, how the central banks operate, they typically control the 3-month rate, and everything else thereafter is controlled by the market, and there's a term structure and a term premium in the market. Here, the BOJ said, nope, we're going to control the 10-year rate, the 10-year Japanese government bond. That's what we're going to control. If that yield rises, i.e. the price falls, then we are going to come in and we're going to buy as much as you want of that bond. We want that yield to stay at zero. And so markets have respected that and put that yield at zero. But now we're seeing inflation pick up in Japan. And so markets are pushing the 9-year, which the BOJ is not buying. They're pushing the yield on that higher. By dropping the price on that, they're pushing the yield higher. And so you're seeing this sort of inconsistency develop in the curve. The BOJ's goal is to maintain the 10-year at zero, and they're doing that job. The markets group at BOJ is doing that job by holding and purchasing very substantial amounts of 10-year JGBs in the market to keep that yield at zero.
What's interesting is even as they deploy yield curve control and the market generally buys it, even as they made their adjustment, swaption vol is pretty healthy. It's not US levels or certainly not gilt levels, but it's not zero anymore. And for a quote controlled asset, it's inconsistent with regard to how the market prices options on the asset versus the lack of movement in the asset itself.
Swaptions are a fungible instrument. Your consistency across the term structure, the BOJ is not going and buying swaptions or receiving on swaps. And so swaptions are free to move, and that's where markets are expressing that view. So a more consistent framework is emerging in the swap market term structure that we see. And so that's why the volatility in the swaption market is actually reflecting the true volatility that there is across the curve in Japan. The BOJ is still holding that 10-year on the JGB curve. And so you are seeing in asset swap markets, you are seeing a distortion in the term structure of the asset swap, where you have a very rich asset swap in the 10-year sector relative to the 9-year or the 7-year as a result of the BOJ presence in that part of the curve.
You're talking about the BOJ's presence in a very specific part of the curve. That's some version of positioning. And that's a term that I think has come up a couple of times in the course of our conversation, maybe starting with LTCM. You just don't get such a vol event without the unwind of very extreme positioning. And you referenced the same thing or a similar circumstance with gilts, with everybody effectively being, the pension community being vulnerable to higher rates and deploying leverage. And you've talked a fair amount in some of our other conversations about positioning and just trying to monitor to the extent you can what other entities are doing, where trades are crowded. Give us some of your thinking on that as we're in the midst of just starting a new year. What does positioning look like to you? Where are there pockets of vulnerability that you and your team are worried about?
There's two areas here, or three areas. Again, you talk about the outlook for 23. Start with Japan. And you look at some of the inflation numbers that are starting to be generated in Japan. And what you have is very extraordinary levels of easing still in place. A pullback from the curve control program, we think, is a volatility event come through fixed income markets. And long-dated fixed income markets are arbitraged across currencies. So if Japanese yields push higher, there's buyers which may shift from buying Europe or buying US into Japan. That will change the structure of US and European interest rate markets. So that's one area that we're watching very carefully. We do think that that's something that participants should and investors should pay attention to in 23. Second piece is actually now coming from Europe. And Europe, the ECB is moving to do quantitative tightening and actually start to reduce the size of its balance sheet. And there is another source of risk in markets. ECB, if you look at some of the support programs that they had, was actually not just focused on government bonds. They were actually out there buying corporate bonds. And the ECB has a substantial holding of corporate bonds as well. And so it'll be interesting to see as they outline the program. I think they're talking about outlining the program towards the end of Q1. It'd be interesting to see, and we're watching for that as to how the ECB engages in reducing the size of its balance sheet. And then the last one here is actually a risk which has really come up and bubbled up late in 22 and now early 23. This is some of the issues that may arise in the US if the debt ceiling is not extended this summer. And that piece of risk, I think, is also worth watching here. Ultimately, the dollar is the global reserve currency, and US Treasury asset is key for well-functioning fixed income markets, risk-free markets, but it's also key for risk assets and spread products. And so if there is volatility in the US Treasury, if there is any kind of volatility of a risk to default that needs to be priced in the US Treasury curve, then the implications there for risk-free assets, for risk assets across the globe, I think are profound. All three need to be watched as outcomes for 23, and they will ultimately feed into risk assets and the outcome for risk assets.
Well, we're having this conversation on a Tuesday. My understanding is that Biden is meeting with new House Speaker McCarthy tomorrow on Wednesday. So we'll see if there's any progress on that front. My skepticism says no, that they're going to take this thing to the wire. It's going to be interesting. And as you said, could be very consequential for the price of risk assets, price of vol. So Deep, this has been an excellent conversation. I've really appreciated the chance to learn more about your framework, hear your insights, and I think our guests are really going to enjoy this discussion. So thanks for taking the time.
Wonderful. Well, thank you for the opportunity, Dean. Look forward to these discussions always. So thank you very much.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.